right, so welcome to Game Plan Sunday. Today is March 21st, 2021. I've been out over the past week and some change on vacation, but I know you guys still been getting it in the market. So I'm glad to be back at home, off the road, very tired from that. But I did get a chance to take a look at some of the action while I was out on the road. In particular, I know we had Powell that came out, with the FOMC minutes meeting, and I've seen the markets react to that while I was out. So that was interesting. I saw it before and afterwards. And I know that Jonathan and Wesley, they were in the group in the chat. So make sure you guys are in the chat, which is right here on the website. You can access it from the news feed or your dashboard or what have you. That bubble down there, you get into the chat right there. Get into the live action. Make sure you're in there daily and interacting, okay? So the only way things pop in the world is that you got to participate. Facebook won't pop if you guys wasn't sharing things on the website. So you can do the same thing on Wallstreet Jackboyz. Share right in your news feed, market-related economic information, financial information on the website. You guys are welcome as well. But y'all know I'm in there pumping it, giving you, feeding it, okay? Giving you all the information you need. But anyway, at the markets the past week, what we had here is that the markets are actually down, okay? We had a Dow Jones that was down negative 0.46%. We had the S&P 500 down negative 0.77%. NASDAQ was down negative 0.79%. The Russell 2000 was down negative 2.77%. So they took a huge blow in the Russell, but they was actually leading up before last week. Then we had oil. The oil markets got rocked, negative 6.18%. So they're kind of back before the rally. We'll take a look at that. The best performance was the dollar. The dollar was up 0.09%, so barely up. And then gold was up 1.5%. Bitcoin was up 2.9%. So that's where we left off at, for the past week. As far as the sectors, performance sectors, was led by communication sector, which is up 0.96%. The healthcare sector was up 0.41%. And consumer staples was up 0.35%. So that's where any flow that was going on was, in those sectors, basically. Okay. So what I'm going to do here is go down to our handy dandy news feed where all the juice is at. This is where you get your studies on at. Okay. We had some economic data that came out. Shout out to Keith, man. My man Chaston, call him Keith. He's one of my childhood friends, military guy. But he posted here a little cheat sheet for you guys, right on the news feed that you can learn from. Okay. But anyway, we had the U.S. import and export price index from February that came out. I just click on it and show you guys. You can see, import and export, those prices are going up. That's all inflationary. So when I'm tracking things like this, basically what I'm just looking for is inflationary. Exports is going up too. So prices of everything is just going up. All right. That's basically what you're going to get for that. And the same for everything else. This is the advanced sales and for retail and food services. This is right on the website. This is actually slightly down for the month of February, which is weird, but it's up overall for the year. Okay, so I may tell you this right here, but it's down for the month coming from January to February. Then that could be from the shutdown Texas thing. I'm not too sure yet, but that's what was came out in the markets. We had the monthly new residential construction numbers that came out as well. Again, you're just getting a sense of people buying homes. What that's looking like. This is like a leading indicator with you get the permits, because before you can build a house, you got to add the permits and all that other stuff. So you can see, you can get a gauge on the markets, like a leading forecast on that by, taking a look at these numbers here. And they're just basically telling you here in the building permits section here, we have 1.6 million, basically. Housing starts with 1.4 and housing completions 1.3. All right. And there's basically saying with the building permits, they were up, let's see. No, they were actually below the revised January rate. So they were down. So we had less permits coming out. But they're saying basically it's 17% higher than last year, February. So it was down for the month from January to February. Then the housing starts with 10.3%, which is below the revised January estimate. So that was lower as well. Housing completion, this is 2.9% above the revised January estimate of 1.3 million. This is 5% above the February numbers. Okay. So this is just, but the housing, just getting a gauge on the housing thing. You see the little chart up in here. You can see it wiggly, the little wiggly lines. You get the extremes right there from 2020. You see we're up here, but then we're getting that downward motion there. So that's something to watch for. Now, what's interesting is that you got to understand when the Federal Reserve pushing those interest rates down really low, this encourages people to go take out debt. Okay, so it encourages you to take out debt. You know, everywhere you go, people's hollering, "Oh, go buy a house, go buy a house." Unlike the last recession, right? The housing crash. You know, we saw houses, the price of homes deflate. They deflated. So homes are cheaper, right? So you get a good deal on a nice house, you should be more inclined to buy it, you know, also, right? I mean, that's what it should be. And then, you know, the interest rates help you if you can manage the debt. And what happens when it feds, you know, floor that interest rate, you know, it encourages people to take on debt. And you got to remember, you know, we're still in a depression, okay? And so to encourage people to continue to, you know, to take out their debt is very reckless. Then also the home prices are still high. They're very, very elevated. So the home prices right now are ridiculous. They're stupid high. So the key to anything, you know, buy low, sell high. Why would you want to buy these homes at these prices that they're now? They're extremely overvalued. But, you know, I get it. You need a place to stay. You got to do what you got to do. But a lot of it, you know, with the Fed's intervention and then government locking things down, you got a lot of people that's been moving, you know, from, you know, California and New York coming down south and other great places with great weather and space already socially distanced down south. You got space. Unlike New York, you like stacked on top of each other like pack a can of sardines. But, you know, people need that space. And then people working from home now, you still need more space. So there's a lot of different, you know, variables that's, you know, encouraging, you know, people to go and buy homes. Okay. So anyway, but this gives you a little insight on what's happening on that front. And then we have the FOMC meeting. I'll just go over some of the highlights here. This is like what really drove the markets, right? So the markets, you know, again, the markets sold off, you know, puke basically. Markets is not feeling what Powell is saying. I've said this a month ago. The Feds are basically going to cook the economy. And, you know, just depend on if the markets believe it. Now we getting, you know, information and we're seeing how the market's reacting. Markets is really not feeling what Powell and them are saying, because you got to remember Powell was on the same drift when Trump was president, thinking that he can normalize the economy after Obama's 8-year extension, which they never suppress interest rates for that long ever. Normally they suppress it for like 2 years. If you go back to every recession, they only suppress it for about 2 years at a time. Obama had a whole regime, 2 presidential terms with no interest rates. So that encouraged people to go buy. That was the time you're supposed to be buying your houses and stuff. Right now is the time you're supposed to be selling, collecting your profits, getting up out. Okay, so, but they were trying to normalize under Trump, but then they couldn't. The markets had a fit, sold off. So Powell them had to do what they had to do to stop basically normalizing rates. They got it to 2.5%. Because you guys remember, every recession, in order for monetary policy to work, they normally need 5% of interest rates to be able to drop. Okay, like when Obama was president, when they killed the interest rates, he had 5%. Every other president before had at least 5% as well. But with Trump, they couldn't get up to 2.5%. So now they're at the floor at 0%. So that is really the monetary policy is not working, you know, in the way that they actually think is working. So we can talk about that later. But anyway, on this one here, this statement here, this is what they said. Now pay attention to the words. They always, you know, this word psychology crap. The path of the economy will depend significantly on the course of the virus, including progress on vaccinations. Tell me why in the hell does the course of the economy depend on a virus? Never in history, okay? It's economics. The only reason why the economy is really messed up is because the government intervention to stop the economy, okay? Depending on the virus or not, it doesn't matter. We always had viruses. Viruses will never end. Viruses will never be eradicated. COVID won't be eradicated. It's an upper respiratory virus. They can't get rid of those. You can't get rid of the common cold. You can't get rid of influenza. You can't get rid of pneumonia. We have these things and we still live normally, okay? I think that we have totally overreacted, but I think that is by design from the central planners that's planning the Great Reset and the United Nations agenda. Was it 2031, I believe? Anyway, you can check it out on their website. They don't hide this stuff. People just don't look for it. Anyway, so what the Fed, what Powell said again, he said the committee will aim to achieve inflation moderately above 2% for some time so that inflation averages at 2% over time and longer term inflation expectations remain well anchored at 2%. Okay. And then I had to highlight accommodative, because how many times this guy has to say accommodative? I'm tired of him saying accommodative. Basically what he's just saying is they're going to keep suppressing the interest rates. Okay. That's basically what they're saying. They like to talk, you know, convoluted. So let's see, the Federal Reserve will continue to increase its holdings of Treasury securities by at least $80 billion per month. They're telling you right there, quantitative easing, they're buying up all the bonds. Ain't nobody buying bonds but the feds. You're not getting no interest rates, okay? So you got to understand, interest rates, when they're high, is good for who, okay? And then it's bad for who? Most people don't understand that. So when interest rates are high, this is good for savers. When you put your money in the bank account, and you put your money, you're saving it, okay, your CDs and all that, you need higher interest rates. Therefore, it encourages you to save money, okay? So when the feds do this, raise interest rates, it encourages people to save money. So it benefits savers. When they drop it, it destroys the savers. It encourages you to take on debt. So anyway, you can see here that, even with these bonds, the rates are, artificially suppressed, but they're buying them all up, right? $80 billion per month, because you can't make no money buying bonds right now. Bonds is trash. And agency mortgage-backed securities, they're buying up the mortgages, okay, by at least $40 billion per month. So it's $120 billion that they're kicking out every month to try to sustain the economy. So that's a lot of stimulus, if you will. Okay. It said that the committee will be prepared to adjust the stance of monetary policy as appropriate if risk emerged that could impede the attainment of the committee's goals. So they're telling you right now, they always say, what do you say? If the risk emerged that could impede, okay, so they're prepared to adjust the stance. That's what he says, right? They're prepared to adjust the stance of monetary policy. He's not actually being blunt and telling you what the hell that means. Prepared to adjust the stance of monetary policy as appropriate if risk emerge. All he is saying is that we're going to raise the damn interest rates. All right. So that's just basic econ right there. He has to raise interest rates. And because he is coming out saying that he's not going to raise interest rates, okay, the markets have a different opinion, okay? And we say the markets, we're not talking about the markets like it's one person. We're talking about the collective of pretty much the consensus on the markets with investors. Majority of them believe that the feds are going to have to pivot from its position prematurely, the same way that it did when Trump was the president. That was in 2019. We got that hiccup, in the markets back then when the markets crashed, basically. So the same thing, they believe that, Powell, he was talking tough then, he's talking tough now, but they don't see it. And you got to understand why. Because inflation, if it gets too hot, the feds have to taper it off or they can't control it. And then you just get, some crazy hyperinflation stuff, which is even worse. I mean, it's a nightmare. Okay, so we can talk about that in a second. I know Dr. Michael Burry, he's been talking about it, a great book that he's been studying and he's been posting. Which I don't have that book, but I do have Ray Dalio's work from the Big Debt Cycle, which I posted I posted some of the stuff on the site for you guys to check out. How this inflation stuff works. I know a lot of people don't understand. I'm always showing you guys, this is the books right here, right? Most people ain't gonna take the time to study all this, right? It's a little heavy, but as Ray Dalio even states, right? Ray Dalio stated that the reason why he go back in history and study, right? Because when he was young, he was a young investor, right? You guys know Dalio, he's the largest hedge fund manager in the world, Bridgewater, right? I mean, he's kind of retired now, but still, in this guy's history, right? And again, I don't agree with everything that Dalio says. I believe he's damn near socialist, okay? But it doesn't take away from his body of work. You got to understand, the guy's a billionaire, multi-billionaire, has more time and money than you and I. He could sit here and study. He could do all that stuff, right? He could do this more than we can. And he did. He had his whole team to go back and recreate in a simulation world, okay, of all the history from back like 500 years and set his ass up in there so that he could actually trade in that environment. And that's what he did. And what he learned from those things is the stuff that he, published in this book, The Big Debt Crisis, okay? That's the name of it. And so it's a lot of clues in here to help us to navigate through these times. It's a lot of work though, right? So I posted some of it on the website. But basically, it's not that whatever happened in history is going to happen today, but it is a good guide to help us to navigate where we are. But Dalio is a young investor. He, almost destroyed his whole firm. I mean, he lost big money live on TV. He made a move. And he said he was blindsided by history, right? He knew what he knew, but the one part that he didn't know was historical information. So he had to go back. And when he went back and studied over 500 years, he discovered these cycles. Ludwig von Mises, I don't have his book over here, but Mises, the Austrians economists, they discovered the business cycles, right? But the Dalio, he just discovered this stuff, but he also noticed that they go over and over. This guy's study go back to the Bible, from the Jubilee years. If you go in the Bible, they talk about the Jubilee. They talk about the Great Reset. I'm constantly telling you guys about the Great Reset. This stuff is biblical, okay? But this guy, he put his body in work and he studied it. And so it's important for us as investors and traders to learn as much as we can. I have some ignorant people that states, oh, you know, you do this and third. No, that's stupid. Study, okay? If they put in the work, you go and study. You want to be the best, you got to study. You want to go toe-to-toe with these guys and you haven't put in any work, you're not going to make it, all right? But good thing is that they actually put forth the studies. So I'll take a look at that in a second to show you guys some of the stuff that I've studied is on the website for you to check out. But basically, the key was that Dalio had to study more. You know, they don't teach you about all this stuff in econ class or stuff like that. That's why people think these economists know everything. They don't. They get it wrong majority of the time, actually, because there's so much history behind how these different policies work, the dynamics. They're all these mathematical variables, basically. So anyway, and so far, Dalio's been on point with all his predictions of everything that's happening. So I make sure I pay attention. Doesn't mean that he's going to be right all the time, but it can help you to navigate. So along with other people as well, okay? Unemployment numbers came out last week, 770,000, an increase of 45,000 from the previous week's revised levels. The last week were low. They ended up revising them up. And basically last week was higher than that. So 770,000, don't need to go into this. The picture is still, you know, it's clear. You guys already know unemployment is still high. So that's another problem when we're talking about the economy. When the Feds and them, they're looking at a number, okay? And like Mises and them say, a number don't make nothing reality, okay? Anybody can do all kind of numbers. Listen, Einstein, in his dying days, he died a lonely, miserable man, okay? He did what he needed to do for the atomic bomb stuff for the government. And after he finished that, they were done with him. He wanted to talk about black holes. He wanted to talk about all this, you know, theoretical math. He got lost in the science of math and crazy. Even Tesla was talking shit about him. Like he said, he called Einstein a bum in a lab coat. He said he's not even a real scientist. He's stuck doing math. The math don't make things real, okay? So you can't ignore reality, okay? And the statistics are normally wrong. I mean, they're just not pinpoint accurate every time. They could change because you're dealing with human action, human behaviors. The markets consist of humans, and humans are not rational. Humans are irrational, right? You got people that buy worthless stocks. You got people buying NFTs. What the hell are NFTs? Like I said, I had a chick who was buying stars. How the hell can you buy a star? Really, you know? So that's why the numbers don't really matter, okay? You have to calculate human action, all right? And that's a better sense there, okay? So anyway, they straight up smashed Einstein out. He was lonely, though. He got off into this math stuff, you know, and these black hole theory, quantum theory, stuff like that. They was like, nah, bro, we need to get you back on building these bombs. And all the young guys, they was help building the bombs. So they took them on and they started ignoring Einstein. He was still talking about these math theories. Now you got to get to the real human action. So Dalio came out on Bloomberg. This is what he said. He said the Fed will need to buy bonds as stimulus boost yields. This is on March 20. All right. Just posted this one. All right. He said the U.S. Federal Reserve would need to buy more bonds as an oversupply of treasuries drives up yields. Okay. The recent fiscal stimulus announced by the Biden admin will result in more bond sales to finance the spending. Okay. They spending money. Somebody got to finance it. Ain't nothing free. He telling you, right? So somebody going to have to buy the bonds, worsening the supply demand problem for the bonds. He said this is going to make supply and demand for bonds that's already bad, problematic. It's going to be even worse, which will exert upward pressure on rates. Dalio said Saturday on this Chinese panel. Then he said that will prompt the Federal Reserve to have to buy more, which will exhibit downward pressure on the dollar. So this is the end game. They're going to have to destroy the dollar. That's what we're going to have to do. He said that the world is very overweighted in bonds and they are yielding -1 basis points in real terms. So they're actually negative. And not only might there be not enough demand, but it's possible that we start to see the selling of those bonds. He said that situation is bearish for the dollar. Okay, it's bearish for the dollar. All right. And then they had to end it. Fed Powell said this week the current monetary policy is appropriate. And there's no reason to push back against a surge in treasury yields over the past month. It's always to sell people on this confidence. It's all a mentality. It's a mental game, right? They never tell you when there's going to be a recession. Although, if you guys listen to Powell this week, that's what he was saying. He was saying, and there was this one guy, the first guy on the panel who was questioning the Q&A section. If you guys take a look at that, and I can send y'all the link. First guy he said, Powell, is it time for us to start thinking about raising the rates? You know, and they got a good laugh out of it, but he pressed Powell pretty good, you know, like, yo, inflation, everybody, the markets are seeing inflation, you know, and the Feds, even their estimates of the GDP supposed to be much higher than what they were previously projecting. They had to increase it. I think they're expecting GDP to be like 6.5% or so. But every year afterwards, it's going to drop, drastically, which is crazy. And that's the problem you have when you inflate an economy. It's not real growth. You know, that air got to come out some kind of way. So everybody sees inflation, even the Feds. But the Feds think that the inflation that's going to show up is going to be what they call transitory, temporary, basically what they're saying. They don't think that it's going to stay. But he's already said it himself, and I heard him in the meeting. He said that they're actually expecting inflation to be like 2.4%. And just so you understand, the Fed have a 2% target. Why they have a 2% target? I don't know. I just, I guess I do know. Historically, the way they've been gauging this number, 2% for like the past, maybe 20 years or so, it's a good average for a healthy economy. So they set that as the benchmark. Okay. So they set that as the benchmark, and that's their goal, and their mandate is to keep that 2% target and keep employment together. And so they're trying to inflate their way into this thing. But like I said before, on the Wonder Woman movie, if you watch that Wonder Woman movie, it sucked. But the lesson of the movie was greater than the movie itself. If you get to the end, I don't want to tell everybody the movie, but the bad guy, he made a lot of wishes to people. But every time he made a wish to somebody, he was able to give them whatever their hearts desired. It had to take a sacrifice for him in some kind of way. He couldn't predict what was going to be taken from him, but he can give, but something had to be taken. And whenever he gave to somebody, he took something back from them. Okay. So when the Feds do these things, there's the same thing, right? The Feds give a stimulus or whatever the case may be. It's going to take from some other part of the economy. You got to try to figure those things out. Okay. You can't just give and nothing happens, cause and effect here. So anyway, but that's what he was talking about here. This is Dalio. And then I caught this one here. All right. This is from Bank of America. All right. And over 220 respondents who are managing $630 billion in assets. This is what they are afraid of. Okay. Well, this is what they're not afraid of. Less than 15% had the vaccine rollout as their top risk. 15%, less than 15% are worried about the damn COVID virus. But, again, you have people that are irrational in the economy, which is the majority of people who are worried about this whole, upper respiratory virus called COVID. But they ain't worried about the common cold. Okay. You don't have to test to know you got that. Your ass coughing, to go in that medicine cabinet and get you some medicine. You don't go to the hospital, you don't get no test, none of that. All right. But anyway, as I digress, in March, higher inflation was the most cited risk at 37%, which is an all-time high. 93% of respondents expect higher inflation over the coming year. Some 91% see the economy improving, and 48% said we're in a V-shaped recovery. Okay, so you got to understand, it's over $630 billion in with assets under management. They are afraid of inflation more than they are afraid of this virus. That should tell you something. Again, you're here because you're trading, you're investing, you want to know the money game. These guys, they know the money game. This is what they do. You feel me? And this is what they are talking about, inflation. So this is what you need to be paying attention to. Okay. So they said higher bond yield means higher borrowing cost, which could hinder the recovery and weigh on corporate earnings. Corporate earnings. Jonathan, you talk about doing the fundamental analysis on those stocks, those earnings. You got to understand higher borrowing costs is going to definitely impact these corporations' earnings. That's what we're trading in the markets. Plus, a higher discount rate produces a lower present value of assets like stocks. Present value, we get the future value, we get the future cash flows. We got to discount back to the present value. That's what fundamental analysis. You got to have a discount rate. The discount rate is the bond, the discount rate. It's in the yields, basically. And so the higher that goes, that's going to weigh on the earnings. And when treasuries produce enough yield, there's greater competition for stocks. So that also causes another change. When yields are higher, investors stop taking on extra risk, like buying Bitcoin, cryptocurrencies, or stocks, and then go back to the safe haven and they get those yields without taking extra risk. You want to make money without taking too much risk. That's the whole key. But when there's not a reward for you to do so, then you take out risk. That's why you're seeing all this money that's going all over in stocks and cryptocurrencies, right? Because you can't make no money off of bonds. It's ridiculous. You might as well take what you was allocating to the bonds and put it into something more riskier. I mean, you can definitely lose a lot. So that's why you don't want to put a lot of your stuff in that. But at the same time, you can make a lot too, right? It's very risky. It's not as calculated as, equities and stuff like that. So he said nobody believed that rates at 1.5% will cause an equity correction. This is the Bank of America's chief investment strategist, Michael Hartnett. But the move from 1.5% to 2% is critical, as 43% of investors now think 2% is the level of reckoning in the 10-year treasury that will cause a 10% correction in stocks. 2%. Okay, this is what he says. 2% in the 10-year. Let me show you guys, and I already had this marked, okay? This is the yield curve. It's on the website. You type in yield curve in the search browser and you'll get that, right? So let me show you guys the yield curve. All right. The 3 months, okay, is the gray line. Boom. 10-year blue line. Boom. I got the 30-year in here. It's irrelevant for the moment. This is a pink line right above. Okay. So, the short term is right here. So we look at the short term as what the Feds control. Let's take a look at the longer term as the free markets, if you will, bond investors, right? They're buying the blue line. Feds is buying this line here. All right. So recession hits, boom. You see that everything drops. Okay. The bond markets, these guys are like the oracles. Okay. They forecasting the future basically. So anyhow, the yields last week as of Friday on the 10-year registered at 1.74. Okay. We can see it right here. Okay. So I got that marked. Okay. And so it's higher than it was before the recession thing hit. And then I had TD Securities. They have a target on the 10-year at 2%, which is right here. You guys can see that. It's right here. So I just got the line right there. That's the target. We're a stone's throw away from that target, okay? So what they're saying is, boom, when this hit this, stocks 10% correction, sell off. That's what that says. So I hope you guys understand that. That's what they're talking about. And that's what the yield curve there. So 10% correction in stocks. Okay, so far, rising bond yields haven't stopped the bull, but dynamics have changed. Value stocks have outperformed growth stocks with far off cash flows worth less under a high discount rate. Some 52% say value will beat growth this year. That's a narrow margin. But after a decade of growth outperformance, value stocks have more fans than they've had in a long time. So we're seeing a little rotation coming out of growth stocks into value stocks. The margin is still very, very close. So who knows if the trend will sustain. With the Feds, interfering with the market, you get more reckless and more reckless and more reckless. And so, I wouldn't be surprised if value stocks start to turn over, and this trend doesn't sustain itself. But it would be good if value stocks did come back into play, because right now everything has been pushed up for growth. And these companies, they're not going to match their future cash flow, their future forecast. They can't do it. Yeah, the economy's too weak. So anyway, it's a bunch of air in that whole situation. And just to take a look here real quick before we go into the charts, the Legends and Gurus group. If you haven't joined the Legends and Gurus group, make sure you check that out. This is where we take a look at the legends and the gurus and see, assess what the hell they're talking about, what the big dog's talking about, right? Because they got all the money, they got all the tools and the resources, they got much more than you and I. So it's good to see what the hell they're talking about. So anyway, in the Legends and Gurus group, if you go under discussions, you can go to the feed, but you go to the discussions, you can get specifically to, which guru you want to take a look at. So all the different gurus are in here. And if you want to see other gurus profiles in here, just let us know. Let me know, and I'll put it in there. But anyway, just take a look at Ray Dalio here, because this is the thing that I was telling you guys about with the whole inflation stuff. You were looking for clues here. You're looking for clues. We use history. You know, things happen over and over again in society. It won't be the first time you have a recession. It won't be the first time you have a depression. You know, but you can actually get information that's like the why, the causality. So anyway, you just scroll down here on the feed. And again, you guys can comment on these and all of that. You know, let's see here. Okay. Yeah, this article right here, the spiral from a more transitory inflationary depression to hyperinflation. And so I was looking at somebody who was talking about Dr. Michael Burry. He's calling for hyperinflation. And he studied this German book that was talking about the depression of Germany at the time. But I remember from my studies with Dalio's work that he went into great detail on it. So I whipped out my book while I was out on vacation, and I put this out here for you guys. This is specifically to how the hyperinflation took place. Okay, like what things took place here. Okay, I'm not going to read it for you guys now. But, Dalio was basically telling you, got to remember, they created a stimulated environment for this guy to trade in. So he's trading, during this time. They recreated the stocks, recreated everything in a virtual world. And he's trading. And, they're throwing news articles at him, and he got to trade through it. He learned some things, and he's like trying to share that with the world of what happened, and the best way to play it. So you can check it out here. But he's basically telling you the best way to invest, that he found from this. Again, doesn't mean this time is going to be like that time, but you get a lot of clues in here. So anyway, I'm not going to take up your time with that, but just know it's on the website. So make sure you check it out. And if you have questions, clues, or anything like that, just, put it out there and, we could talk about it. Okay. We can continue the conversation, but this is on the website and I want you guys to check it out so you can have some insight. So you don't be clueless when they keep on talking about transitory inflation. Okay. You'll know what the hell they're talking about. All right, so from that, let's take a look here at equities. Right now, S&P 500 up slightly. We take a look off to the right here. It's up slightly at before markets. 1%, 1 point. 1 point. Nasdaq up 39 points. And just take a look at the charts here. I don't really see any clear setups in anything right now. I think things are really, really choppy. We can see this was the blast off. This was the floor. We came up here and we got a stoppage. We didn't even get to our extension. And now price is starting to, go downward. Price is also under its moving average on a daily chart. So under the 8 moving average. It's just turning red now. And we're right here on this floor. So it's a little tricky environment we're in. We don't really have a trend. We're in a chop zone right now. So you want to play this careful. We got the stochastics is going down. We have a sell arrow up there. Things are going down. You're in a messy looking squeeze here. Trend is also going down. Doesn't mean we're going to, sell off right now, but I would expect the markets to be up much higher now that, they passed the 1.9 trillion, stimulus, and they rolled out the $1,400 checks, and that money should be hitting the economy right now as we speak. And so I would imagine that the markets should be more excited. But it appears that inflation is worrying the markets more than these corporations getting all that money, because people are going to spend the money. I mean, that's why I've been able to predict this, because it's just logic, okay? And they're going to spend the money. So anyway, I'm in a very choppy territory. So you want to tread softly here. If the markets, let's say the markets open up positive in the morning, it's Monday, it's a lot of pent up energy. Monday, it will be more of a day trading session, if anything. You're not going to find any key trends, but right now I don't see any real prints. So hopefully you guys got some prints. Ron, I hope you got some patterns out there. You got some pattern plays or something. Get those cooking for me, homeboy. Look, I'm back off the road, okay? But yeah, so anyway, markets is looking real tricky right now, real choppy. We're not going to get any hard print on Monday, but just in case you see it rally up, don't get too excited. And I believe we have a witching expiration this weekend, this Friday coming up. So things will be really volatile. the NASDAQ. Okay. So the NASDAQ you got that's down here. You got the NASDAQ that's down here, bouncing off of the 100, but no clear indication here. Price is trading under the 8 moving average. So again, it's more choppy. It's in a squeeze, but we got some divergences in here. I can't call direction with this kind of environment. Now, this thing could play any kind of way, right? So, but typically when I see this kind of pattern, this is what normally happens. It bounces up to the 618. Do you know what happens next? What normally happens is this. That's what normally happens. That's what I normally see with this kind of pattern. Don't know if that's going to be this break, if this is going to be the fallout here, because then it could rip up on us and turn into a freaking double bottom setup. It could turn into a double bottom, right? You know, don't trust the little arrow in here. It's just letting us know it bounced off the 100. But that pattern, okay, this pattern normally does that. All right. But I don't know. Things are still early and the markets is real trippy right now. I expect the markets to be much better with stimulus rolling out, but they're not. So this inflation situation might be really bad, but I don't know. We'll see. I can tell you this. In fact, I want to ask you guys this, okay? Because the $1,400, I just don't think that it's enough to get them what they want. So the Feds may have a point. I'm just playing devil advocate here, right? They may have a point, right? The 1,400, that thing's probably going already for most of those people. And I've been out. I've been all over Alabama, Tennessee, Georgia, South Carolina, North Carolina, just, traveling through the state here yesterday, just getting back. And people are out. I just left Cold Stone ice cream and I couldn't even get in the door. I missed a line out the door. So somebody's spending some money somewhere, right? So again, I think this inflation situation is really, really not looking good. And that's why it's important for you guys to study. I know people have been talking about like Kathy Woods and all these, gurus. I'm not telling you to ever blind follow any guru. It's important to take a look at their strategy and learn from it, but don't be following people. Her portfolio is getting ate the hell up the way she got, herself positioned, but she kind of called it. She kind of called it though. She's smart, but don't be blind following people, man. Do your own study. All right. The Russell here, again, price is under the moving averages. Okay. We got price action under the moving average. Everything is shifting down. So to me, doesn't look too good. And let's take a look at the dollar here. We take a look at the dollar here, and the dollar is looking like it's flagging. It's bagging, flagging, berry. Okay. So you can take a look at it. Again, looks like a flag. It looks like the opposite of the pattern I just showed you guys. I don't know if that's what's going to play out, but these patterns normally play out like this. And I think we can get a rally right up into this 200 moving average, that yellow line right there. So I see the dollar going higher short term. Long term, again, we talk about this, the dollar being destroyed. That's going to be long term. But I think that we can get a, upturn in here short term time frame. And when the dollar is higher, equities are lower. That's the way that we normally see these things take place. But just remember, we have an economy that is not rational because of the intervention of the government and the Feds. And so entrepreneurs had to try to figure out how to move through this, and they do some illogical things, doing things out of the ordinary and trying to get yield. And so things are really crazy. That's why it's hard. Nobody has a clear trajectory for you. No economist, nobody knows, right? Because we're trying to anticipate human action. But you got to take risks. And so, I'm pretty confident in my training. So we got the dollar. Interesting. We had the VIX. And normally this line here that I have drawn down here, this orange line is what is a good floor for the VIX. Okay, we can see it right across here. VIX normally holds this. And, normally it breaks through, it comes back up, right? So this is, to me, is normally an oversold, and you normally get that rally that comes after it dips to this level. We got a dip here, and it's starting to snap back. So if the VIX is going to go higher, this is going to be bad for equities. It's going to be bad for stocks. Don't know if that's going to happen this week, but just taking a look at the story, which we just talked about, the story from the news feed, we got a dip here, and it's starting to snap back. So if the VIX is going to go higher, this is going to be bad for equities. It's going to be bad for stocks. Don't know if that's going to happen this week, but just taking a look at the story, which we just talked about, the story from the news feed, Now we take a look at the technicals. Things are actually not looking good. VIX oversold. Don't put too much weight in the VIX though. Because the VIX be sleeping sometimes. But when we see this, that bright red candlestick is a reversal candlestick. So when it does that, it shoots back up. If the VIX pop up, that's going to be bad for equities. All right. So with that, what else? I'm not seeing any patterns. I'm not seeing any clear setups in pretty much anything. I'm not seeing any clear setups in gold either. Gold is real tricky right now. Gold should be much higher. Gold should be much higher. Gold is at again, much attractive price. We saw it from the last game plan Sunday that we did. Talked about it bouncing off this floor, and that's exactly what it did. It's bouncing, but it's moving slow. Okay. So, we got some, it's coming up here. We got a buy trigger that's in there, but on a fast stochastics, it's looking a little overbought. So I'm not too sure on gold. I just know that, this will be a counter trend trade. Gold has to make its way up through the 50 moving average, the 100, the 200. It's definitely got to make its way up there. Okay. Typically you will see that it will perform, but we got a lot of, treachery going on right now. So I don't have the sense of confidence in it just yet. Just not yet. But long term, gold is the play. All right. And what else? I'll just take a look at a couple of big boys, and I'll take some from you guys. We'll bring it to a close, bring sets to a close. But taking a look at like even the names like Amazon, right? Is not looking good. Amazon is looking like no bueno, Look at the 200 moving average in there. Price is under. Price is also under the 9 moving average. Okay. And typically, again, you'll see that kind of pattern I was telling you. It come up and hit that resistance, and it normally does that. Okay. So I think that the NASDAQ needs Amazon to come through in a big way, and that doesn't happen, they're done. All right. So you got, Amazon, where people are ordering stuff all day, every day. You would think that they would be doing better. Facebook had a good week, actually. Don't really know why Facebook is having a good week, but they definitely had a good week. Yeah, Facebook definitely had a good week. It rallied up to the 786 retracement up here. This is a resistance level. 1 time, 2 time, 3 time. Okay. 3 times it's hit this level. The other time it didn't clear it. This is this time, the 4th time. So it clearly has trouble clearing this level. We see price that's up there at this level. So the move from Facebook would have been, the week prior going up. All right. Or a week ago. They've been getting there, and then you rally up. This is where you would sell off at. So we got a little sell trigger that's in here. Stochastic, it could go a little higher, but I just don't quite see it. I don't quite see it. But yeah, definitely on that. Let's take a look at Netflix. People have been watching the movies. People have been watching the movies, watching the shows. Let me just remove this time here. All right, and we'll just swing from this high to this low that's in here at that level. But again, this is not looking good. It's getting pinched in here with the 200 and the 100, but it's still under the 8 moving average. And it's starting to look like that pattern that goes like that. I don't really know. But again, these stocks are, concentrated in that tech space. Now, the bright red candlesticks, are normally reversals on my charts. And it's at this 200. Okay, this is a floor. So if it holds this floor, then we can get a bounce back up. All right. And it may do something like a inverse head and shoulders, but it's got to hold this 200 line. All right. If it don't hold this 200 line, it's done. All right. All right. And then Google, that is. They're in the squeeze. But we have, again, some sell triggers in here. I can't call a direction on this one here. What I do know is that the price is trading under the moving average. That is bearish. That is not good. Okay. But you can see that it's flagging up here. It's in a squeeze. We'll have to see if it can hold its 50 moving average. If not, it's just gonna get sold off just like the rest of the NASDAQ. So be wary of that. All right. So just cover the big boy names. I just want to cover those real quick. I'll take a look at these setups from you guys, and then we'll come to a close. Jonathan Kim coming through with the Take Two Interactive. So Take Two, it is oversold, but it's still struggling and it's still chopping underneath this moving average. And so again, you can see the massive sell-off trading underneath that 200 moving average. And for me, it's got to clear that 200 moving average for me to have a bullish bias. I know that it's oversold, but that doesn't mean it can't sell off some more, because now that 200 moving average is also resistance, because now price is under it. So it can get stopped out up here. Okay. So I mean, I like the zone. I think it's good to keep your eye on it, but don't pull the trigger until it crosses over the resistance. It's got to cross over this resistance. All right. If it don't cross over, don't pull any triggers. What else we got? SNE. Sony. All right. It's another one of those interesting patterns. That's why I said the markets don't really have any good prints for us here. Normally, again, we'll have some good prints, but they're shaping up kind of like the same thing. It could be something like that. Not too sure. The good thing about this is that it's actually trading above its moving average. I would like to see it hold this moving average as a floor before we can go long on this thing. But if it falls more, look for the 100 to catch it. Okay. And then you can probably start building a position once there. But, you know, these tech companies, they are on some treacherous waters right now. And then he said Coke. Yeah, Coke is it's in a squeeze. Interesting. I mean, you would think that Coke would actually be doing some good numbers with the economy opening back up. You know, things opening back up. They're going to need to sell Coca-Cola to somebody. So the story actually looks pretty good. But price, you know, price is underneath that moving average. Although the 100 is holding for right now, and the 200 is there as well. But it's not to say that this thing won't sell off. I got a little short up in here, and the trend is looking downward. So for me, it's a no-go for me. But I can see you. I can see your play looking to the short side. Just watch that 100 moving average resistance right there. That floor, excuse me. So watch that floor, because that can rip on us and go the opposite way. 5. My man Mark in the building, all the way from Texas, man. Yeah, Mark back in the building, man. Y'all know they had to deal with that mess down in Texas, man. So I'm glad to see my man's back in the building. Got the news on the short. So also Topaz, you got the inside scoop. See, Topaz out here playing billions, man. Y'all don't even know. She got the news on the short. Yeah. So 5 below. Got about $210 target on this one here. Price is still choppy though. I mean, this thing is, it ripped. It rallied up and then it dropped all the way down. That was a huge drop all in the same day. Then it came up a little higher. But we can see my little moving average is red. I would like to see this build just a little more if I go into it, but it looks a little good. It looks a little good. So with the union stuff, drop the story to news feed, Topaz. I'll take a look at that. For that Coke joint. Yeah. All right, cool. But yeah, man, I'm back. I'm glad to be back. Had a good time, you know what I mean? So, but a lot of things to do, and you know, get the website tweaking and everything. So yeah, I mean, you guys already know where to find me at. Y'all know where I be at. I bees in the trap. Bees in the trap right here on the website. You feel me? So, but anyway, man, I'll let you guys get back to your evening. Holler at me. I'll be on the site just doing some maintenance and things like that. But yeah, we'll catch up for the rest of the week, man. You guys have a good night. Peace.